right, so welcome back, guys. So 11.3 is going to be the last depreciation method for depreciation, which is going to be straight line. This is going to be the one of the most easiest, or the easiest one to do. Now, again, it does use all the 5 components, and this time, instead of using units produced, it also does use the same thing where it is using the estimated useful life. Now, when we talk about straight line, right, it is exactly the title as it says. You're going to depreciate it in a consistent or constant number. So that means every year or every month, however you depreciate your assets, you're going to depreciate the same amount every single year. All right. And the goal of straight line is to actually take the entire asset cost, right? And what you're going to do is you're going to divide it amongst its evenly amongst its useful life. So here is the formulas. Okay, so if the goal is to try to spread the cost evenly amongst the useful life, right? Let's take a look at the formulas. The formulas is going to be a combination between the units of production and the double declining, okay? So for the depreciation basis, it's going to be exactly like units of production. The depreciation basis is going to be the cost of the asset minus salvage value. Okay? And then the depreciation rate is going to be similar to double declining because it's going to be 1 over its estimated useful life. However, since you're only doing it once and not twice, it's only 1 divided by the estimated useful life. So there's no times 2, so that's what's similar to the double declining. And of course, the depreciation expense is going to be the rate times basis. And then, as I've mentioned before, the accumulated depreciation and the book value those formulas stay the same. They're going to be the same thing, right? Where accumulated depreciation is going to be your previous year's accumulated depreciation plus current year's depreciation expense, and book value is always going to be your asset cost minus your accumulated depreciation. Okay? So let's go ahead and dive into our very first example here, where we bought a machine and it was worth $15,000. The salvage value was $2,500, and the estimated useful life is 5 years, and it can produce up to 10,000 units, and the date that you place into service is going to be as of January 1st. Assuming that you're doing depreciation at the end of the year, December 31st, all right, let's go ahead and solve for the depreciation basis. So here it's going to be asset cost minus salvage value. So you take your 15,000 minus 2,500 to give you 12,500. The depreciation rate is going to be 1 over the estimated useful life. So in this case, 1 divided by 5, which is 20%. So that's the number that you're going to be using, 20%. So then the depreciation expense is going to be pretty straightforward. Rate times basis. So in this case, 12,500 times 20% is going to be 2,500. All right, and then that's going to be your accumulated depreciation because there's no previous years. So then what does book value become? Well, book value, right, is going to be the asset cost of 15,000 minus the depreciation, accumulated depreciation. So therefore, it's going to be 12,500. All right, let's do the second year. Second year, right? cost of the asset minus salvage value. So 15,000 minus 2,500 will give you 12,500. Your rate is going to be 1 over 5, which gives you 20%. Your basis times rate is going to be the same thing. 12,500 times 20% will give you 2,500. And what you're going to notice is year 2 is exactly identical to year 1. And then what you're going to notice is the rest of the years are all going to look identical. So here, at the end of the day, the basis and the rate stays the same, all right? And of course, the depreciation expense also stays the same. It's a constant number. So this is what it means to have it in a straight line, right? You're not fluctuating up and down. You're not depreciating it twice as much, half every single time, or you're not doing it based on how many units you produce. In this case, you figure out one number and you're going to spread the cost evenly amongst over its estimated useful life. So in this case, I took a lump sum number, divided by the number of useful life it has, and boom. That's it. One number. So in this case, if you could solve for one, you could solve for the whole entire thing, no problem. And then, of course, the only thing that you're really calculating is the accumulated depreciation in the book value. So as you can see, we're just adding 2,500 every single time, right? To get you to the end goal of 5 years, you get the end of 12,500 to make your book value at the end of year 5 to be 2,500, which is equal to your salvage value. Okay? Pretty straightforward, right? So again, how do we journalize it? Same thing, right? We're going to journalize it as depreciation expense and accumulated depreciation. So it's going to be 2,500 because that's what we solved for the first year. Okay. What about the second year? It's going to be an identical journal. You're going to depreciate it for the same exact amount, but this time in year 2. Okay. So in this case, when we journalize it every year or every month, it's usually typically going to be the same entry all the time. Okay. Now, what happens when partial years come into play? So if there is any reason that you come across a partial years, then the first year when you depreciate it, yes, it will change. However, the years after that are all going to be identical. So let's take another look here where we bought a machine that cost us $10,000 with a salvage value of $2,500, and the estimated useful life was 5 years, and the number of units it could produce is 25,000 units. And once again, we placed it into service as of October 18. Now, in this case, October 18, what does that tell us? Okay, since it's again less than 50% of the month. So in this case, right, if it didn't fall for between the 1st and the 15, in this case it fell after it, so that means it's definitely less than 50% of October. So therefore, that tells me that I need to only depreciate it for the month of November and December, so only 2 months. So in this case, how do I solve for my numbers here? Well, depreciation basis is going to be cost of the asset minus salvage value. So 10,000 minus 2,500 will bring you 7,500. Your rate's going to be 1 over the estimated useful life, so 0.2. And then, of course, you're going to take your 7,500 and multiply it by 20% to get 1,500. However, if you just placed it into service as of October 18 and you're doing depreciation at the end of the year, December 31st, right, because it's an adjustment, usually it's going to be at the end of the accounting period, or, the accounting period. So in this case, if I'm assuming that I'm depreciating it as of December 31st, therefore, I'm not depreciating it for a whole year. I'm actually only depreciating it for only 2 months because it's only 2 months old. So in this case, right, I do have to come across here and say, no, 1,500 is for the entire year. So in this case, I have to calculate it, right? I got to figure out what 2 divided by 12 is, which is 0.16667. Again, you could just go put it in straightforward, as in you take your depreciation expense, or you take your depreciation expense of 1,500, multiply it by 2, and divide the whole thing by 12. You'll get the same exact answer here to get $250. Okay. So again, you're going to plug in this for your journal, but every year after that, it's going to be the 1,500. Okay. So that is straight line for you. Any questions in regards to straight line? It's the easiest form of depreciation, and it's the most widely used and most acceptable for IRS. This is the one where you're not having to figure out numbers constantly. If you figure out one number, the whole thing pretty much solves itself. And that way, when you do this, you don't need to have to be precise, or you don't have to keep calculating. It's one number, and you're spreading the cost evenly amongst the asset's life, right? You're taking the asset cost and dividing it completely evenly through the life. Okay, right? Any questions?
No. Teacher,
Yes.
we have 1,250 after 4 years and 2 months. This is a 5 years. What about the 6 years, the last year for this value after first year, second year, and 6th year?
Which one are you talking about? This table over. Which table are you talking about?
Yes.
Okay, so in this case, right, if you have to go for a 6 year, well, how old is your asset? If it's only 4 months and two, if it's only 4 years and 2 months old, how much longer can the asset hold up to?
Hold up 4 plus 2 months.
Yeah, but how much more is left?
10 months.
Okay, there you go. Then you just solve for 10 months, and then you get your even answer out at the end of the 6th year.
Thank you.
Yes. Okay. We'll do an example in the exercises after this. Okay.
Okay.
Any other questions? Okay, so I'm going to talk about chapter 11.4, amortization. Okay. Now, when we talked about the definition of depreciation, amortization is more or less the same exact idea, where I'm devaluing, or again, instead of appreciating, like adding value to it, I'm depreciating, which is subtracting value to an item. In this case, it just depends on what kind of asset I am depreciating, right? So in this case, when we talk about amortization, the real thing about it is that it is meant for intangible assets. So again, it's for anything that you can't physically touch. Okay? Now, when we can't physically touch these kind of items, right? Usually these ones are kind of more difficult to depreciate, or they have some kind of, they're definitely different when it comes to intangible assets, that you have to treat them slightly different. Now, for any reason, like for example, an intangible asset could be any patents, any copyrights, licenses, trademarks, legal rights. All of these will never have a salvage value. Usually these kinds of things you have, in order to uphold the copyright, you have to go repurchase it, and basically it expires at the end of a given time period, right? You have to go renew the license, or you have to go renew a copyright. And the more that you renew it, right, you're looking at rebuying the value of it and making it more expensive every single time. Because it depends on how, for example, Disney, right? Disney owns all the copyrights to everything, right? But their copyrights only last about 25 years, right? So that means they have to renew it every 25 years. And what they do too is they license it to other companies to use the copyright for it. So in this case, right, at the end of their license, they have to renew the contract for them to continue keep using the copyright. Does that make sense? So at the end of intangible assets, there is no salvage value. There is no value after it's been expired. Now, we definitely have the cost of the asset, right? Depending on how much you value a patent, or how much, I believe there's some kind of way that you can measure the value of how much a patent can be, depending on how good your idea is. Or you could also invest in a specific, say, this is a $10,000 idea. Okay. Now, when you buy a patent, copyright, license, or any of those things, right, they have a huge variety of length in time. Okay. The estimated useful life could vary. It could be 1 year, it could be 3 years, it could be 5 years. Okay. And in this case, I just took an average of it, and I'm going to say, well, if a lot of copyrights could be anywhere from 25 years, and of course it could also range to just having only 1 year licenses, then I'm going to say, well, for this class, just know it as 15 years. Okay, that's kind of in the middle, all right? And that way we don't have to figure out any other number besides the 15 years, okay? Now, how we amortize an asset is going to be exactly the same exact thing as straight line. Okay? Because in this case, there is no salvage value. There is nothing at the end of its life. So in this case, how we're going to amortize an item is going to be, we're going to be using straight line. So let's take a look at this. Now these are the formulas. All right, I just replaced it. So instead of having the asset cost minus salvage value, if we know that amortization doesn't have salvage value, then you're going to start off with the asset cost. And it's going to be 1 over the estimated useful life. Expense is going to be basis times rate, and then so on and so forth. The amortization, accumulated amortization is going to be identical, and the book value is also going to be identical, okay, to the depreciation. So so the only difference here is there's just no salvage value. Okay? But everything goes exactly the way it goes. So once again, let's do this example here where you bought a patent. Once again, the cost of it was $20,000, and it's worth it's worth $20,000. Its useful life is 15 years, and the date that you place it into service is as of January 5th. Okay? Now, in this case, right, when you buy a patent, usually copyrights or anything like that, any legal documentations, is effective immediately. So the day that you buy it is going to be the day that you start depreciating it. So in this case, the rules for that also apply, but what I mean here is that if it's January 5th, it starts on January 5th. Okay? So let's take a look at here, amortization basis. Okay, it's going to be cost of the asset. So in this case, $20,000. Okay. The amortization basis is going to be 1 over the estimated useful life. Okay, so 1 over 15 is going to be 0.06666667. And then again, your rate times basis is going to be whatever your 20,000 times the 6.06666667 is, which is going to give you $1,333.33. Okay, and then the accumulated amortization is going to be the same. Book value is going to be your 20,000 minus the 1333.33. Okay. So again, let's solve for the second year, right? If it's going to be the same exact ordeal as straight line, you're going to know that the first 3 columns are going to look identical. The only thing that you're really calculating here is just the accumulated depreciation and the book value. So in this case, right, if we know that year 1, then if we started as of January 5th, we know that we're going to depreciate the whole entire item for the whole entire year. So in this case, right, once again, you take your 20,000 times the 0.0066667, you're going to get the same exact depreciation expense for 1333.33. And all you're doing is just adding it together to your accumulated depreciation and then subtracting it out from your actual total cost to get your book value. So in this case, same ordeal here. And this time, when we journalize it, instead of using depreciation expense, you're going to swap out the word depreciation, and it's going to be amortization. Okay? Pretty straightforward, okay? It's the easiest concept, so amortization is just as easy. If you know straight line, then you know exactly how to do amortization. Okay? So again, chapter review, we talked about straight line versus amortization. Here are the formulas here. They're side by side, pretty similar. The only thing that you need to know here for straight line is it is where you're trying to spread the cost evenly amongst the estimated useful life, where amortization is meant for intangible assets, and it follows the exact same method as straight line. Okay, so let's go ahead and dive right into the lesson here. Okay. All right, or the exercise here, okay? Here we are. Okay, so for this exercise, we have here that we purchased a coffee maker for $250, okay, with no salvage value, okay? Its useful life is 5 years, okay, and it can make up to 25,000 pots, okay? And of course, you place this into service as of January 12th, okay? So in this case, assuming that you are doing depreciation at the end of the year, December 31st, right? What did we buy?
A coffee maker.
We bought a coffee maker, okay? At what price? Or what's my asset cost? 250. Good, sorry. Okay, what's my salvage value?
There is none.
There is none. Okay. What's the estimated useful life?
5 years.
And what's the date that we placed into service?
January 12th.
So what does that tell me? Do I depreciate the as of January, or do I depreciate it the next month?
As of next month.
Okay, so in this case, it's between the 1st and 15.
Oh, okay. So January.
Yes, because in this case, right, it's definitely more than 50% of the month, right? Because if you split the month in half, the 15 is basically half the month. Okay, so in this case, it's a little bit before the 15. So we are going to depreciate it as of January. Okay. So let's go ahead and solve for our depreciation basis here. So what's my depreciation basis?
It is just 250.
Good.
There's no salvage.
Correct, right? It's your asset cost. Let me do that again. It's your asset cost of 250 minus salvage value, which is 0. That's going to still give you 250. Okay? What is my rate going to be?
20%.
Good, right? 1 divided by 5 gives you 20%. So then what is going to be my depreciation expense for the first year?
50.
Good, right? You're going to take your depreciation basis times your rate, which gives you $50. So then what is your first year's accumulated depreciation?
50 as well.
Yes, because there's no previous years accumulated. So you're just it should be the same exact as your depreciation expense. Okay. And last but not least, what is the book value as of year 1?
200.
Yes, so you take your 250, right? You're going to subtract 50. You're going to be left with $200. Okay. So then let's depreciate for the rest of the year. So what about the second year?
The depreciation basis and the rate are going to be the same as well. Like depreciation expense.
Correct. So they're all going to be the same, right? It's going to be all the same throughout all 5 years because it's all going to be the same exact formula, right? Your depreciation basis is always going to remain as cost of the asset minus salvage value. Your rate's going to also stay the same as 1 over its estimated useful life. And of course, if these are the same, right, if it's going to be consistently being 250 times 20%, then your depreciation expense is also going to stay the same. So in this case, right, my accumulated depreciation for year 2, how much is it going to be for year 2?
100.
100. So then that leaves my book value to be
150.
150. All right. What about my accumulated depreciation as of year 3?
150.
150, leaving your book value to be at the end of third year
100.
100. All right. And then again, you're going to add another 50 to make this 200 to make it remaining only $50 left. And then of course, by adding the last 50, you're going to get your accumulated depreciation at the end of year 5 to be 250. So again, 250 minus 250, you are down to 0, which is equal to your salvage value. Okay? If you do this on Excel, you'll finish this a lot quicker. Okay? So then now let's go ahead and calculate, or in this case, journalize for journalize our adjustment entry for the first years of depreciation. And then the second question asks for the second year of depreciation. So if I'm assuming that I am depreciating at the end of the year, December 31st, how should my journal look like?
Depreciation expense on the debit side and credit accumulated depreciation on the credit side.
Good. For a total of
50.
50. And of course, if I were to depreciate it for the second year,
It's going to be the same.
it's going to be identical. Okay? Good. All right. So let's go ahead and dive into question number 4. Okay? Let's take a look at this one. This time, okay, I purchased a couch for $2,485, which includes all fees and tax and et cetera, et cetera. Okay? In this case, right, it has a salvage value of $150. Okay? And its useful life is 7 years because it's furniture. And of course, you put this into service as of August 25th. Assume that the adjustments are made at the end of every single month. Okay. So in this case, what did I buy?
A couch.
You bought a couch. All right. What was your asset cost?
2,485.
$2,485. Okay. What's the salvage value?
150.
150. All right. Estimated useful life?
7 years.
7.
7 years.
I'm a little confused.
Okay.
I thought you said that they didn't have salvage values, or am I confused?
That's for intangible assets. We're still on depreciation.
Okay.
So in this case, date that I placed into service?
August 25th.
August 25th. So what does that tell me?
You start in September.
You start in September. Okay. So in this case, let's go ahead and solve for our depreciation. Okay. So in this case, right, what is going to be my depreciation basis?
The 4,085.
Okay. 2,485?
Oh, and then you subtract with the salvage value.
Correct. So in this case, what is my depreciation basis going to be if I have to subtract 150?
2,335.
Perfect. $2,335 is going to be your depreciation basis. Okay? What's my rate going to be?
It'll be 0.1428.
Yes. So in this case, we're using 7 years instead of 5 years, right? Because in this case, you're going to learn that furniture, right, can definitely be longer than 5 years. It's, it's a couch, it's furniture, right? They have a lot more heavy duty, steady life than, machinery. Okay? So in this case, it's going to be 0.1428, so on and so forth, right? So therefore, I need to use my equal round. So again, what is going to be my depreciation expense?
It's gonna be 326.90. Oh,
326?
I didn't put the full number. That's why.
Oh, okay. All right. Okay. So in this case, $333.57. Now let's take a look at this depreciation very carefully. Now, in this case, if you read very carefully, it says that assume that the adjustments are made at the end of every single month. In this case, is this for the whole year or is it for the month?
For a month.
$333.57 is for the
Correct.
whole
Whole year.
How do I depreciate it for just 1 month?
So you only depreciate just 1 month.
Divide 12.
You divide the whole thing by 12, right? How many months are in 1 year? So if this is equivalent to 1 whole year, I'm only looking for 1 month. So in this case, I just divide the whole thing by 12. Okay? Now, in this case, so if I divide the whole thing by 12, I'm going to get $27.80.
But I need for 4 months.
Who says you need it for 4 months?
From September, October, November, December.
Am I doing the adjustment at the end of the year? No, the adjustment's done at the end of the month.
This end of months, but I need for yes, end of the every month.
Right. So in this case, does it matter when you place into service if you are depreciating at the end of each month? Okay, so again, depreciation is not always going to have to be at the end of the year, right? It's the end of the accounting period. So you can have it at the end of the month. At the end of the month, it's going to be at the end of the day when you calculate all of the depreciation for the 12 months. That's going to be equal to the same thing at the end of the year. Okay, you're just doing it at the end of the month, so you don't have to calculate it all at the end of the year. Okay, so in this case, I'm only focusing on the first month. And that's going to give me $27.80. Okay, so then my accumulated depreciation is also going to be $27.80. So then what is going to be my asset cost at the end of the first month of depreciation? I'm sorry, book value. I said asset cost.
$2,307 and just 20 cents. Oh wait.
You're very close. It's the 24, not the 23.
Okay.
Yeah, you're taking asset cost, not depreciation basis. Okay? So in this case, it's 24.5720. So then let's solve for the second year. What's my depreciation basis going to be? it should definitely be the same. Okay? So it's still going to be 2,335 because it's the formula will always stay the same. So it will always remain your asset cost minus salvage value. What about your rate?
Same as well.
This will also stay the same. Okay? Now, if these two numbers stay the same and I'm depreciating at the end of every single month, then what is my depreciation expense going to be for the second month?
Same.
It's all going to be the same because if this is for 1 month worth of depreciation, it's all going to be the same, right? It's going to be your 23,350, 2335 times your 0.1428 divided by 12 to give you what depreciation is going to be for the month. So then in this case, right, let's go ahead and continue doing all the calculations for the accumulated depreciation. What's my accumulated depreciation for the second month?
5560.
5560, bringing your book value to be
2,460. Wait, what?
2.
I don't know what's it.
Okay, remember, it's going to always be this number up here, to the 24 2485. Okay? And again, when you do the next depreciation, you don't take the one above. You continue to take the asset cost of 2,485 and you're subtracting at the 5560.
Oh, okay.
Yeah. Okay. Okay, so then what about depreciation, accumulated depreciation for month 3?
So can we go back again? So are we're subtracting it from the 2485 or from the book value?
We're subtracting it from the asset cost. The formula is book value equals cost of the asset minus accumulated depreciation.
Okay.
Okay? So in this case, you're always going to take it from the 2,485.
And your accumulated depreciation is always going to be the 2780 plus 2780 plus 2780 all the way down?
Yes, because it's accumulating. It's always going to be previous accumulated depreciation plus current year's depreciation expense. So yes, you're basically adding it on top of each other.
Equals 82.8.
82, 82, 55,
So what did I get?
60, 55, 60 plus 27, 2780
55. Okay.
should give you 8340, right? 6 plus 8 is 14. 5 plus 7 is 12 plus 1 carry should be 3. Yeah, it should be 8340. Okay. And then now, what is book value? If you're going to subtract it out from the $2,485, okay? $2,485 minus 8340. What is my book value now?
240160.
240160. Okay. So then, since Maribel said that you're just constantly adding 2780, 2780, 2780, and that's exactly what you're doing. You're just going to be adding that to those numbers. So there, the next one is 11120. Next one is going to be 139. Next one is 166.80, and then the one next to it is going to be 194.60. So you're just adding on top of it, because in this case, we're just racking up every single month's depreciation. It's accumulating, okay? So in this case, let's go ahead and solve for all the book values. So what's my book value as of month 4?
2373.80.
2373.80. What about the book value at month 5?
2346.
2346, okay. And then the depreciation, book value as of after month 6.
2318.20.
2318.20. And last but not least, what about month 7?
2290.40.
2290.40. Now in this case, right, I'm doing this by month. Now how many months is going to be 7 years?
84.
84 months. So you have to do this for 84 consecutive months. The same exact number for 84 months, okay? So it's very important that you do read in context of when your depreciation is going to be. So this time, I'm looking at depreciation at the end of the month instead of at the end of the year. So let's go ahead and answer the questions down below. Number 5, okay, record the adjustment entry for the month of August for the first year. So how should I record the depreciation as of August for the first year?
So you would debit depreciation expense for 2780 and then accumulated depreciation for 2780 on the credit.
Okay, so that's what you said, right? In this case, in the month of August, right? When did I place my asset into service?
In September,
Exactly. So in August for the first year, is there anything I can depreciate?
No.
No. So again, this is another trick question. No, there's no entry here because you don't depreciate until September. So no entry. Okay. So then question number 6 says, now record the adjustment entry for the month of September for the first year. So then this one now is going to be, if it's September 30th, right? Then you can go ahead and say that, yes, I can depreciate it. Depreciation expense, accumulated depreciation. Since I'm in the month of September, then yes, I can go ahead and depreciate it for the 2780. Okay. So then now, question number 7 says, record the adjustment entry for the first year, assuming that depreciation adjustments are done at the end of the year of December 31st. And it was calculated annually. So then now, I'm asking you, if it's December 31st and you do the adjustment at the end of the year now, how do I record my depreciation?
2780 4 times.
2784 times. How much is that? Twenty.
100,
Go ahead.
111 and 20.
Yes. If I look here, right after 4 months, right? September, October, November, December, right? At the end of this, my accumulated. So basically all the depreciation expenses that were happened between those 4 months have accumulated up to 111 and 20 cents. So in this case, yes, it's going to be 2780 times 4, which in this case, I can just simply look at my chart and know that the end of the month for the month 4, I've already accumulated up to $111.20. Okay. Right. Okay. So, any questions here?
No.
Okay. Number 8. Okay. We're going to do an amortization now. Oops. Way too big. Okay. Way too small. Okay. So, amortization. Okay. In this case, right? We, on January 12th, we end up purchasing a copyright for $2,500, okay? Its useful life is 15 years. Okay, so in this case, what did I buy? I bought a copyright. Okay? How much did that copyright cost me?
2,500.
2,500. Okay? In this case, because we're doing amortization, we know that there is no such thing as a salvage value under amortization, because when you buy an intangible asset, there shouldn't be a residual value, a salvage. It should be worth nothing at the end of its life because it has an expiration date, right? You have to renew it. And when you renew it, you repurchase it for a higher value if you believe that it's worth more money. Okay? So in this case, no salvage value exists under amortization. Okay? How many useful life does it have? How many years?
15.
15 years. And what's the date that you placed into service?
12th of January.
12th of January. So therefore, what does that tell me?
That you do it on that month.
Correct.
Appreciate
Correct. So in this case, what's my basis going to be?
15,000. I mean, 2,500.
It's going to be 2,500 because in this case, it's the cost of the asset. Okay? What's my rate going to be?
It's gonna be 0.066666.
Right? It's going to be 1 over its estimated useful life, which is 15. Excuse me. So therefore, it's going to be 0.00 0.0666666667. So it's going to go on. Okay? And what do we know about the rate? Okay? So it's going to be 1 over its estimated useful life. So then, in this case, assuming that I depreciate the end of the year, okay? So then, what is going to be my depreciation expense for the first year? So this one I'm going to use an equal round.
It's gonna be 166.67.
166.67 is correct. Okay? So then, accumulated depreciation should equal your first year's depreciation expense. So then what's my book value going to be?
233.33 cents.
Exactly. Good. Okay. Okay, let's go ahead and do it for the next couple of years. So then, year 2, what's my depreciation expense? I'm sorry, depreciation basis going to be? In this case, amortization basis.
It's gonna be the same.
It's all going to be the same because in this case, right, we have no salvage value. The only number that we have is the cost of the asset. So in this case, if that's going to be the only formula that my basis is just going to equal my cost of the asset, then all 5 years is going to be the cost of the asset. And then same thing with my rate, right? It's always going to be 1 divided by the estimated useful life. So therefore, this 0.066666667 is also going to be consistent. So then, what is going to be my depreciation expense for year 2?
It's gonna be the same as well.
It's going to be the same, right? Because if I have my basis and my rate to be the same, then basis times rate, that's the formula for the depreciation expense. If I'm doing the same numbers over and over again, it's going to appear to be the same exact numbers all the way through. Okay? So in this case, what is my accumulated depreciation for year 2?
333.20.
300. Are you rounding up?
Oh no. Yeah, I forgot to put the 7. That's fine.
Okay, okay. All right, so 33, 33, 34. So therefore my book value is going to be
2001.
good, 2,166 and 66 cents. Okay? So then what is my accumulated depreciation for year 3?
It's gonna be 501 cent.
501 cent, which brings my book value to be
100. I mean 1,999.99 cents.
good. So then what's my accumulated depreciation for year 4?
666.68.
66, 66, 68. Okay. So then that brings my book value to be
1,833.32.
okay. Last but not least, what is going to be my accumulated depreciation as of year 5? Okay, which will bring my book value to 1,666 and 65 cents. So then in this case, right, same ordeal as straight line, except the only difference here is there's no such thing as salvage value. So in this case, let's go ahead and record the adjustment entries for the first and second year. So this time, assuming that I am doing my my amortization at the end of December 31st. So in this case, what is my journal going to look like?
Amortization expense.
Okay.
Amortization accumulated.
Accumulated amortization. Good. Okay. For how much?
16667.
166.67. And then for year 2, it will look identical to year 1. Okay. All right. Good job. Any questions in regards to straight line and amortization?
No.
Okay, so we are done with chapter 11.3 and 11.4. Okay, so what I'm going to have you guys do tomorrow, since tomorrow is Thursday, we're going to go over the chapter 11 review. Okay, so again, today is another short day, just because, again, we just learned another set of formulas. I don't want to confuse you anymore. Tomorrow, we will practice all 4 methods, so including the amortization, and you make sure that you don't get confused because we are going to be looking at all 3 of them. So again, they are again completely different formulas from each other, and one of them is very similar. It's a mix between, it's a hybrid between the 2 methods. So make sure that you try your best to remember. Now, what I would recommend you have your cheat code or your cheat sheet out with the formulas on there so it can help you answer the questions a lot easier, okay? Because for this one, like I've mentioned before, if you understand or you know the formulas, it's just straight plug in formula. That's it. You just plug them in. So in this case, that's all you really have to do, okay? So again, we're going to end the class early, okay? So if there is no questions, I will see you guys